So the whole point of this session now is to talk a bit about the discount opportunity within investment companies at the moment. I'm sure you all know what that means, but basically, for those that don't, it's basically the gap between the value implied by the share price and the value of the underlying portfolio, the value of the assets, which is normally called the net asset value or NAV. And it can be quite a big number, but if you buy something at a 50% discount and it goes to asset value, you double your money. So there is quite a lot of opportunity there to make some serious money. So this is what we're going to run through quickly. Some facts and figures about what's going on at the moment, why discounts have widened at the moment. Are these numbers correct? Where are some opportunities? I'll take through as many of those as we can in the time, and a few pitfalls to watch out for. And the reason that, that these things do close quite suddenly sometimes, what we've seen just in the past week is Blackstone came along and bid for Industrials REIT, which is one of the companies that we cover. So it's a portfolio of logistics assets. It was trading at quite a significant discount to asset value. They've just come along and paid a 42% premium to what the share price was before. So that discount's gone really quickly. But although there's all this hidden value there in the sector, some of it can take a long time to unlock. And I used to unlock those for a living. That's what I used to do. Now it's just a question of educating you as to where you might go and look for opportunities. This chart here is just showing you what the median discount of all the funds in the sector has done over time. Things went crazy in COVID, that day when we all thought the world had stopped, in March 2020. But they bounced back really quickly after that. But what you see is, since about March 21, we've seen this gradual decline in discounts. And a lot of that is linked to interest rates, but not all of it. In numbers, we cover about 346 funds. And the gap between what they're worth in the market and what the underlying value of the assets is worth is £34 billion. So it's a huge number to exploit at some point. There are some really extremes in this. So at the top end, you've got a fund like JP Morgan, Emerging Europe, Middle East and Africa, which is on a 133% premium to asset value. At the other end, you've got tiny little things called Jade Road and Infrastructure India. They're on a 97% discount, which is just crazy, but there are maybe good reasons for that. This chart is trying to show you how many funds are actually trading at a discount at the moment. So if we go back to September 2017, it's normal for things to trade at a discount, but they're normally not very big. And I think as we see some numbers on here, 5 years ago, 28% of funds were trading on premiums. 86 of those, that's 86 funds. Now that figure's just 9%. So there has been quite a big derating. And I said this is where the valuation opportunity comes, and this is why we think the sector is interesting at the moment. But what's been driving this? What's been going on? There are three main reasons. So one is interest rates. One is that the big wealth managers are selling. And the other one, I think, is that just investors are just a bit disillusioned after a poor 2022. So I think it's just a combination of all of these things. So this chart now is showing you the chart I showed you before, which is the discounts on all funds. And I've just overlaid it with the yield on the 10-year gilts. And that's useful because that's quite a good indication of where people think interest rates are going. So obviously they've been climbing as we have to tackle inflation and the interest rates up. And that has been one of the factors that's been driving discounts down. And that is because, simply, if you can put your money in the bank now and actually get interest from the bank, you've got a sort of a risk-free option, then you want sort of an extra premium on top of that for investing in something risky like an equity or a bond. So those sort of, everything's kind of shifted upwards in terms of yields. And also, quite a lot of these things are valued on a discounted cash flow basis. So they look at all of the income they're going to earn in the future, and then they sort of discount it back again. And those discount rates have had to go up as well as interest rates have gone up. So that's driven down their NAVs. And there's a bit of anticipation that that's going to carry on going. Now I'm going to let Ed talk for a bit about the wealth managers.
You hear me?
Yep.
Yeah, perfect. Thank you, James. So, yeah, why are the wealth managers selling? currently, as you can see from some of the headlines, Rathbones, Investec Wealth are merging, and some of the others are merging. RBC and Brewin Dolphin have merged, and this is creating a liquidity issue for them. They're just too big to invest in investment trusts, or they most likely will be. And you can see, even for large funds like BH Macro, which is £1 billion in size, when Rathbone and Investec merge, they'll own 35% of that. So, it is very difficult for them to invest in smaller cap equities or investment trusts. So, despite the good structure they have for especially a liquid assets, because the lack of redemptions, etc., the structure holds versus its open-ended colleague, it is proving difficult for them. The other aspect is that many of these larger wealth managers have sort of model portfolios, and they're sort of, I guess, generalizing, of course, but they're putting their customers into these model portfolios, and maybe a little bit less bespoke than they used to be. But if you are doing that, and you're doing that in size, you're going to really need a lot of liquidity in the underlying. So if you're sort of high growth, bump, you're in that basket, then and you've got customers coming in and out of these sort of buckets, you really do need liquidity. And investment trusts for private investors is fantastic and provides liquidity. But if you are of this massive size, coming in and out of them is quite tricky. So you are seeing some selling in the market, and I don't think we've seen the end of that. But yeah, and I think we touch on that slide there. I think. Yeah, here's quite interesting. You can see the shift from retail. You see, retail buying more of investment trusts. You can see the institutions pulling out of the market. That's happened quite to some extent in the equity sector. The alternative space, less so to date, but that's changing. And the reason for that is that when you are doing an IPO or you want to raise capital, the institutional market is a lot easier to raise capital, and there's a lot more quick moving. There's a lot of money that can move quite quickly to raise the amount of capital. When you do an IPO, do a capital raise, you want to do it quite quickly and close it. And you need to get to a sort of minimum size for a number of reasons. So we will see, I'm pretty sure of it, a shift from the institutional markets on both pie charts there, but in particular the alternatives one, I think, because now the alternative sectors are trading at discounts and you can't issue stock at a discount, we will see retail growing. And this is, like James put on these slides here, this is why the investment companies are here today and they're coming along to meet you. The retail investor is exceptionally important to the sector. Thank you.
Cool. Thanks, Ed. And actually, I was just talking to the guy from Next Energy, who's in one of our stands at the village at the back, and he was saying that just over the past couple of years, his register's gone from less than 10% retail to nudging well into double digits now. It's going quite quickly. 2022, we all know, was pretty dreadful. What that chart shows there is just the returns on a whole range of different asset classes. I know it's all a bit jargony, but you've got things like China was dreadful, bonds were awful. They were almost nowhere to hide, and I do think this is part of the reason that people are a bit sort of miserable at the moment. And actually, for the sector as a whole, I nicked this chart from the AIC, who's the sort of industry body, but they say that 2022 was the third worst year for the industry since 1995. Fortunately, you might be able to see from this thing that when we have a bad year, the subsequent years tend to be quite good. So we're hoping that maybe 23, 24 would be an awful lot better. I can't guarantee you that, but fingers crossed. Now, I did make the point earlier on that you have to be careful about whether these numbers are correct or not. So the biggest premium is this thing that used to be JP Morgan Russian. I was just talking to somebody else about this earlier on. It's on a big premium because all of its Russian investments are valued at zero at the moment. And there's a sort of hope value that maybe we'll get some kind of resolution with the war, maybe Russia will be okay again, maybe they'll be revalued again. So the reason it's trading at 133% premium to asset value is that kind of option value in the Russian stuff it's got. It's a total gamble, I think, whether that comes off or not, whether you want to take that gamble. The reason why these things are trading at enormous discounts is because they're really quite eclectic, unusual. Infrastructure India's sort of teetering on the brink of bankruptcy, to be honest. Its manager's been lending it more and more money to keep it going. There are big question marks over what the assets are really worth. And that is something you have to be careful of. Also, not all these asset values that these companies publish come out every day. Some of them only publish monthly, some of them only publish quarterly. Some of the things that they hold are quite hard to value. I mean, it's quite easy to take a portfolio of equities and come up with what the NAV is straight away. But if you've got a whole portfolio of solar farms or of music rights or something, these are quite things too expensive to value, and it's more of an art than a science. You just sort of have to factor in a lot of different things to come up with a number. And it all kind of depends on what the second-hand value of all these things are when people are trading between them. We let you, on QuotedData, do go away and have a play with it. That's what we're trying to get you to do today. We let you rank things. You can compare all funds. You can look at them by individual sectors. You can rank them on discounts. You can rank them on things like dividend yields, how much the ongoing charges are, for running costs, how big they are, and then, importantly, is the performance. So you've got short-term and long-term performance numbers. There you can see who's doing well, who's not. And then there's a lot more information behind it, as I was going to explain in a second. Now, this totally depends on how much time we've got. I've got a few examples. I don't want to spend too long on these. This is just ranking all the funds in the biggest discounts. So we've got the J-Rate Infrastructure India we talked about a second ago. Home REITs in there. Now, you've probably read an awful lot about that. This has been a complete disaster. I hold shares in it. I'm quite sort of embarrassed for the sector that it's happened. But it's very rare that you get these big scandals like this, but when they do happen, they are quite dreadful and not really helpful. We really don't know what the assets are worth, because one of the rumors is that they deliberately overpaid for some of the stuff that they bought, and somebody was siphoning off the money. We just don't know. It's the sort of thing where I'd say possibly it's cheap, but there's not enough information for you to make your mind up. I'd be quite wary of it. In any case, it's suspended, so you can't trade it anyway. But because it's had problems, things that in adjacent sectors, like Triple Point and Civitas, have been knocked too. And here I think that discount is way, way too wide. It's got a stream of income which ultimately has come from the government, and it's providing accommodation for people with special needs. So they have to adapt the houses to do that. And it's 61%, 22% discount, and quite a high yield as well if you looked at that number. You also seen a big sell-off in growth companies. So these were all the rage a couple of years ago, but then since interest rates are going up, anything that's like unprofitable or maybe profitable in a few years' time has been massively derated. I think that's been overdone. The Schroeder UK company, it was always on the back foot anyway because it used to be Woodford Patient Capital. And we know that he massively screwed up that. The Schroders have done quite a good job of trying to pull that back together again, but it and Chrysalis have been significantly derated. And we stopped again. No, we've gone too far from the thing. Okay. No? This has stopped.
You've got 10 minutes left,
yeah.
time-wise.
No, it's not doing anything. Oh, here we go. There we go. Music royalties, another one. So Roundhill Music, Hypnosis. Again, they raised an awful lot of money very, very quickly. They bought song rights. And one of the big question marks is whether they paid too much for those. What Roundhill did the other day was, because there's been one guy valuing all of these things and coming up and telling you what the NAV is. They actually commissioned somebody else to do another valuation on a different basis, and they came up with more or less the same number, which is kind of encouraging. There's a big story behind music rights that I just think is quite encouraging if you look at it long term, because Spotify and Apple Music and all these things have got their streaming music. They're collecting money from lots and lots of different people and then passing it across to the owners of the songwriters. That, as income's been going up, there's a big lag between the income going up and the cash coming in. And at the moment, we haven't seen the evidence that what they've paid for, they're actually getting decent yields on. So Hypnosis also had borrowed some money and then didn't fix the cost of the debt, so that went up. So they're all sort of, there's good reasons why the discounts widened out. But we might see in the next lot of accounts, we might see that the cash flow is coming through and then things are starting to look rosy. It's a possibility. Something that I do think is almost certainly undervalued are all the private equity funds. I don't really understand why, particularly things like Harbourvest and Pantheon, which are massively diversified. They try and de-risk things as much as possible by spreading the investments out. They are on 50% discounts, and the performance is actually very good. The performance of the private equity funds is actually much better than the listed funds over 10 years, not to in the short term, over 10 years. And I think that can keep going. So I think there are some opportunities in the private equity space. The example we kicked off with, where the bid came along from Blackstone for Industrials REIT, property, we know that it was overvalued. We know that some of them borrowed a lot of money and they're having to adjust to the new higher rate environment. But there is big demand for warehouses and industrial property. And actually in Europe, where the e-commerce thing is actually lagging where we are in the UK, there's more demand even than they have in the UK. And so the rents are going up. Generally, everything's quite favourable. I think Tritex Eurobox 70 European Logistics, they probably look too cheap to me. And then, just to make sure, because I'm sure some of you know that we get funded by companies paying us to write research on them. Hydrogen One is the only one, Hydrogen and Tritex Eurobox are the only ones of these things that are actually our clients, the rest aren't. I love hydrogen. I just think it's really interesting. A lot of people have been disillusioned because it's ridden a big wave up and come down again. And now governments seem to be piling money into it. There is the Inflation Reduction Act in the US. There's like billions and billions of dollars subsidy to produce hydrogen. Repower EU, which is the same thing in the EU. Same thing. It's all starting to happen. And Hydrogen One is the only real way of playing that in a proper fund. And then another thing that seems to be oversold is biotech. And again, you get it because it's unprofitable stuff and profits in the future and all those sort of things. But actually, what the big pharma are doing is saying, look, these things are too cheap, and they're coming along. We've seen an awful lot of bids recently. So RTW has actually been performing quite well because it's been selling things to big pharma. So that's that. I'm going to let Ed talk a bit quickly about the website and how it works.
Minutes left. Thanks, James. Yeah, so we're still on where are the opportunities. You can use QuotedData.com to compare, as James said, we cover every single investment trust and REIT. It's not a select number, but we cover them all, and write news and write research on it. But you can see our data tables here, which are unique on that basis, covering the whole market. But you can filter it through via dividend yield or various other metrics, market cap, discount, dividend yield, gearing, all these sort of things. You can when you're on that table, you can then click on a company, and then you can find out a little bit more about a trust. So some more general information about some market cap, the managers' names, and in gearing and discount and charts, NAV charts, latest dividends. We've also got some on the desktop version. You can look at the share registers as well, which is quite interesting, especially with these sort of mergers of Investec and Rathbones. So you've got the top shareholders there come through, and this has been designed by us, and the feeds come through from Morningstar. And then we'll have a list of the research that we've got there and the news on the fund next to it on the page. And you can see you've got the front cover there, but we've got some example research on research on every client on our stand here today. But we go into quite some detail into each fund, and you can get information here, and you can also chat to our analysts today who are on the page.
So very quickly, I said I also mentioned the pitfalls. So it's very tempting to look at something and say, look, this is great. I can buy a pound's worth of asset for 70p. This must be like a great opportunity. But I do want to warn you that this is, you have to be careful and you have to do your research, which is what we're trying to encourage you to do today. And this is what QuotedData is all about, is giving you that information to do that. So first is, can you trust the NAV? Is there going to be a catalyst for discount narrowing? Is it likely that somebody's going to come along and bid for it? Is it the sort of thing that people might look at? How good is the corporate governance? So one of the great things about investment companies, as opposed to investing in open-ended funds, is you've got a board that's working for you. And if they're not working for you, you can vote them out. Then you can go and talk to them, and you can talk to the managers. It's much more interactive than it would be with an open-ended fund. But you do get the odd board where they're just not really bothered. I mean, one of those examples in that list there was a thing called Hansa, where it's just owned by one guy and his sister. They own most of the shares. They have non-voting shares and voting shares. They don't bother about the discount, and it's never going to close unless they decide to. Sometimes, it's quite rare now, but there used to be sort of poison pill type things within the structures. And so you get managers' notices periods of like 3 or 4 years or something, and they'd be quite expensive to get rid of them and fire them. Debt is a big one. Debt is the thing that always catches people out, to look at gearing. It's a great thing about investment company structures. You can use gearing to magnify the returns, but sometimes it's too big. So have a look at that. And then, is there a sort of community of like-minded shareholders in there? There are some activist investors. It's what I used to do. But there are still some of them around. And if you see them on a register, the chances are that they're beavering away behind the scenes normally to try and do something about the discount. And then part of the problem with NAVs and discounts is how quickly it is to turn the underlying fund into cash. So if you did just say, this isn't working, let's liquidate it, how long would it take to wind it up? There are a few examples. There are quite a lot of funds in there that are in wind-up mode now. And it's going to take 2 or 3 years to get your money back. The other thing I just want to mention before I hand over to Ed to do the closing stuff is that I'd also be very wary of buying things that are trading on big premiums. The JP Morgan fund is a different sort of thing, but we did have quite a lot of infrastructure funds, for example, that were trading on 20% premiums not very long ago and are now on 2 or 3, 4% discounts. That's probably permanent lost money. They're not going to get that back. They've got no incentive to try and drive the premium back to 20% again. It is something to be wary of. Right.
Thanks, James. And just in closing, I've talked about the website. You can get information on our website, data. We've got one of the largest libraries of videos where you can meet the managers. Actually, you can meet the managers in person today, and they're speaking on the stage. But a large library of videos and information on upcoming events like this one, and often discounts or free vouchers to get into them. We've got a huge glossary there, educational material. We have a regular, every Friday we have a news show that James does, and or one of our analysts at 11 o'clock on Friday.
Yep.
Which is well attended, and you're all able to come to that, and all of this is free for you to sign up. YouTube channel, please follow us there, and just sign up if you can. Just sign up to our website. The more we can get signing up, the more influence we have with the industry to try and get them to come and see you. And I think given that the change in share registers, I think you'll see a lot more asset managers coming to shows like this, and which is all great, really. But that's really it from us. And if you've got any questions, come to our stand, come and meet James and our analysts, and enjoy the day. Thanks for listening.
Thank you very much.